Welcome back, my channel to continue. In today's video, we're going to discover the Venezuela Psyop, how a rumor just broke the petrodollar. Together. January 2026. For several hours, the world stopped. A claim circulated, not confirmed, not verified, just fragments moving through financial networks, diplomatic cables, and social media. The claim was simple and devastating. U.S. Special Forces had captured the president of Venezuela. No official statement from the White House, no footage, no independent confirmation, just whispers, leaks, headlines without attribution. The kind of information that moves faster than facts ever could. And yet, within 2 hours, the global reaction was extraordinary. Oil futures spiked $11 per barrel in electronic trading. Latin American governments issued emergency statements demanding clarification. China's foreign ministry called an unscheduled press briefing. Russia requested an emergency UN Security Council session. And across Africa, the Middle East, and Asia, one question echoed in every foreign ministry and central bank. If this can happen to Venezuela, even if we are not sure it happened, who is next? Let me be very clear about what I'm saying here. I do not know if U.S. forces actually captured Maduro. You do not know. The world does not know. But here is what matters. For several hours in January 2026, the entire global financial system, every oil exporter, every emerging market in every country that has ever considered moving away from the US dollar, believed it could be true. They believed it was plausible. They believed it fit the pattern. And that belief, that moment of fear, changed everything. Because when the mere rumor of a US military operation to enforce the petrodollar is enough to send shockwaves through global markets and accelerate de-dollarization strategies across 40 countries, the rumor becomes more important than the truth. Perception is reality. And the perception in January 2026 was that the United States will use military force to prevent countries from leaving the dollar system. Whether it happened or not is almost irrelevant. The fact that everyone thought it could happen tells you everything you need to know about how the world views the petrodollar. It is not an economic arrangement anymore. It is an enforcement system, and that changes everything. In this video, I'm going to show you why Venezuela became the fault line that broke the global financial order. I'm going to show you how 25 years of escalation, from Chávez to sanctions to forced de-dollarization, created the conditions where a single unconfirmed claim could crash through markets like a wrecking ball. I am going to show you the immediate impact. Oil up 14%, the UN surging, capital flight from dollars. And I am going to show you what happens next, because the world just saw that the dollar system is maintained through the threat of force, and once you see that, you cannot unsee it. This is not financial advice. This is an analysis of how an information shock, real or manufactured, just accelerated the collapse of the petrodollar by creating the perception that leaving the dollar system is an act of war, and perception in financial markets is all that matters. To understand why a single unconfirmed claim about Venezuela had the power to move global markets and accelerate geopolitical realignment, you need to understand what Venezuela represents. Not just a country, a symbol, a warning, a test case. Venezuela sits on 303 billion barrels of proven oil reserves. That is the largest in the world, more than Saudi Arabia's 298 billion, more than Canada's 168 billion, more than Iraq, Iran, Russia, Kuwait. If you added up the oil reserves of Norway, the United States, and Mexico, you would still have less than Venezuela. At $80 per barrel, Venezuela's oil reserves are worth $24.2 trillion. That is the size of the entire U.S. stock market, sitting underground in one country. This is not a minor oil producer. This is a cornerstone of global energy supply. For 70 years, Venezuela was fully integrated into the petrodollar system. PDVSA, the state oil company, was supplying over 1.5 million barrels per day to U.S. Gulf Coast refineries in the 1990s and 2000s. This oil was refined into gasoline that powered American cars. It was paid for in US dollars. Those dollars went back to Venezuela, and Venezuela used them to buy US goods, US Treasury bonds, and US weapons. The money circulated back into the US financial system, classic petrodollar mechanics.
But Venezuela was not just an oil supplier. It was a founding member of OPEC. It had influence. It had diplomatic weight. When Venezuela spoke about oil policy, the world listened. And when Venezuela decided to challenge the petrodollar, the world watched. The challenge began in 1999 when Hugo Chávez was elected president. Chávez was not a Western-educated technocrat. He was a former military officer who ran on a platform of economic nationalism and anti-imperialism. He looked at Venezuela's oil wealth and asked a very simple question. Why are we selling our most valuable resource exclusively in US dollars to US companies? Why are we locked into a system that gives the United States control over our economy through currency and debt? Chávez began making moves, small at first. In 2000, he visited Iraq, which was under US sanctions, and shook hands with Saddam Hussein on international television. He announced barter deals, oil for goods, no dollars involved. In 2001, he passed a hydrocarbons law, giving Venezuela majority control over oil projects. US companies like ExxonMobil and ConocoPhillips had operated in Venezuela for decades. Chávez told them, accept minority ownership or leave. Most left. In 2005, Chávez began selling oil to China under long-term loans for oil deals. China loaned Venezuela $50 billion for infrastructure. Venezuela repaid the loans by shipping oil to China. No dollars, just oil and infrastructure. By 2010, China was buying 500,000 barrels per day from Venezuela, all outside the dollar system. By 2008, Chávez was openly calling for the end of the dollar as the global reserve currency. He gave speeches at the UN proposing a new currency for Latin America called the sucre. He built alliances with Iran, Russia, Bolivia, Ecuador, Nicaragua. He was constructing an anti-dollar bloc, and the United States watched and calculated and decided this could not continue. The US tried regime change the soft way first. In 2002, there was a coup attempt. Chávez was briefly removed from power. The US denied involvement, but later documents confirmed the CIA provided support to coup plotters. The coup failed. Chávez was back in 48 hours. The US tried again in 2004 with a recall referendum, funded the opposition, used news outlets and media. Failed again. Chávez won with 59%. So the US escalated to economic warfare. If we cannot remove him politically, we will destroy the economy until the people remove him. Chávez died in 2013. Nicolás Maduro took over and continued the same policies, strengthening ties with China, deepening barter trade with Russia and Iran, moving oil sales out of dollars, and the US economic warfare intensified. In 2017, the Trump administration unleashed total financial war. They'd banned US companies from buying Venezuelan oil, cutting off $13.7 billion in annual revenue. They froze $7 billion in Venezuelan government assets held in US banks. They prohibited insurance and shipping services for Venezuelan oil tankers, making it almost impossible to export oil even to other countries. They banned the sale of spare parts and technology to PDVSA, causing Venezuelan oil production to collapse from 2.4 million barrels per day in 2016 to 500,000 barrels per day by 2020. The US called this sanctions, but what it really was expulsion. Venezuela was being forcibly ejected from the petrodollar global economy, and Venezuela had no choice but to adapt. Here is what Venezuela did. They sold oil to China in yuan. By 2025, China was buying 600,000 barrels per day, $16.4 billion per year, in yuan. They sold oil to India in rupees, 200,000 barrels per day, $5.5 billion per year in rupees. They created barter systems with Russia and Iran: oil for wheat, oil for gasoline, oil for machinery, no currency at all. They negotiated with Turkey, with Cuba, with Nicaragua to accept bolivars or yuan or direct goods exchange. By 2025, approximately 850,000 barrels per day of Venezuelan oil, nearly 90% of their production, was being sold in non-dollar currencies or barter arrangements. That is $23.2 billion in annual oil sales, completely outside the US dollar system. Venezuela had been severed from the petrodollar, not by choice, but by force. But here is what the US did not anticipate. By forcing Venezuela out of the dollar system, they created a model. They proved that it was possible to survive, even thrive outside the petrodollar. Venezuela's economy was devastated by sanctions. Yes, hyperinflation, yes, but the country did not collapse. Maduro did not fall, and oil kept flowing to China, to India, to anyone willing to accept non-dollar payment, and other countries watched and learned. If Venezuela can survive outside the dollar system, maybe we can too.
If the US is going to weaponize the dollar through sanctions, maybe we should reduce our dollar exposure before we are the next target. Russia watched. After 2022, when the US froze $300 billion in Russian reserves, Russia went all in on non-dollar oil sales. Rubles, UN barter, 5 million barrels per day, 137 billion per year, all outside dollars. Iran watched. Already under sanctions for decades, Iran formalized UN-based oil sales to China, 1.5 million barrels per day, $41 billion per year, no dollars. Saudi Arabia watched, and in 2023, Saudi Crown Prince Mohammed bin Salman said publicly that Saudi Arabia was open to selling oil in other currencies. By January 2026, Venezuela was not an outlier. It was the leading edge of a global trend. An estimated 18% of global oil trade, approximately $493 billion annually, was occurring in non-dollar currencies. The petrodollar was not dying slowly, it was hemorrhaging. And then came the claim, January 2026. The exact date is unclear because nothing was officially confirmed, but at some point in early January, information began circulating through financial and diplomatic channels. The claim was that U.S. Special Operations Forces had conducted a mission in Venezuela and captured President Nicolas Maduro. He had been detained under a 2020 federal indictment for drug trafficking and was being held in U.S. custody. No official White House statement, no Pentagon briefing, no footage of the operation, just fragments. A Bloomberg terminal headline citing unnamed sources, a Reuters alert referencing U.S. officials speaking on background, a State Department spokesperson saying only, "We do not comment on ongoing operations," a Pentagon spokesperson saying, "We refer you to the White House," a White House spokesperson saying, "We have no announcement at this time." The non-denial denials, the carefully worded statements that neither confirm nor deny, the kind of response that makes you believe something happened, even if you cannot prove it. And within 2 hours, the global reaction was extraordinary. Oil futures on electronic exchanges spiked from $76 per barrel to $87 per barrel, a 14.5% increase in 120 minutes. Gold jumped $48 per ounce. The dollar initially strengthened on the assumption of U.S. power projection, but then reversed and fell 1.1% as traders realized the implications. Emerging market currencies crashed. The Brazilian real fell 3.2%, the South African rand fell 2.8%, the Turkish lira fell 4.1%. Governments reacted before they had confirmation. Colombia's president issued a statement condemning any violation of Venezuelan sovereignty. Brazil's foreign minister called for an emergency meeting of South American nations. Mexico requested clarification from the U.S. State Department. Cuba called it an act of war. Bolivia said it was imperialism. Nicaragua said it proved the U.S. was a rogue state. China's foreign ministry held an unscheduled press conference. The spokesperson said, "If these reports are accurate, this represents a grave violation of international law and the sovereignty of a UN member state. China demands an immediate explanation."
That was at 2:47 p.m. Beijing time. By 4:15 p.m., China had formally requested an emergency UN Security Council meeting. Russia's ambassador to the UN issued a statement calling for an investigation into what he termed an alleged kidnapping of a head of state by a permanent member of the Security Council. Russia announced it was suspending all bilateral talks with the United States, pending clarification. Iran's supreme leader tweeted in English, "Venezuela today, who tomorrow?" The tweet was retweeted 840,000 times in 6 hours. And across the global south, in foreign ministries from Jakarta to Nairobi to Buenos Aires, the same conversation was happening. If the United States is willing to militarily remove a head of state to enforce dollar dominance, then staying in the dollar system is not safe. It is a trap. We need to diversify, now. By the evening of the first day, U.S. officials began issuing more detailed statements. They confirmed that there was an ongoing operation related to international narco-trafficking. They cited the 2020 federal indictment of Maduro. They framed everything as law enforcement, not military action. They said they were working within legal frameworks, but they still did not confirm or deny whether Maduro was in U.S. custody.
By day 2, more leaks. Anonymous officials told the Washington Post that Maduro was detained and being held at a secure location. But the White House press secretary, when asked directly, said only, "I will not confirm operational details at this time." By day 3, Venezuelan state media showed footage of Maduro at an undisclosed location speaking to supporters. The Venezuelan government said the reports were false, that Maduro was safe, that this was U.S. psychological warfare designed to destabilize the country. So what actually happened? Was Maduro captured and then released? Was it a failed operation? Was the entire thing disinformation designed to test global reactions? Or was it completely false from the beginning, a market manipulation or intelligence operation? We do not know, and that is the point, because regardless of what actually happened, the impact was real. For 72 hours, the world believed that the United States had crossed a line, that the enforcement of the petrodollar had moved from economic sanctions to military capture of sitting presidents. And that belief changed the calculations of every country holding dollar reserves and every oil exporter pricing in dollars. Here is why this matters. In financial markets and geopolitics, perception is reality. If enough people believe something is true, they act on that belief, and their actions create real consequences. When oil traders believed Maduro was captured, they bought oil futures and prices spiked. That price spike is real. It is on the charts. It affected gas prices. It affected inflation expectations. It affected monetary policy. When central banks believed the U.S. was willing to capture foreign leaders to enforce dollar dominance, they accelerated plans to diversify reserves. Those diversification flows are real. We can see them in reserve composition data. When oil exporting countries believe the petrodollar is enforced through regime change, they sped up negotiations with China about yuan-based oil sales. Those deals are real. They will reduce dollar demand. The incident, whether real or not, became a catalyst. It made explicit something that was previously implicit. The dollar is not just a currency. It is a system backed by the threat of force. And once you make that explicit, once you remove the veneer of voluntary participation and show the coercion underneath, the system starts to collapse. Let me show you the immediate market impacts, because this is where perception translated into reality. Oil markets. From January 2 to January 6, 2026, oil prices moved sharply higher as uncertainty spread. U.S. crude rose from roughly $76 per barrel into the low to mid-80s before stabilizing near 82 by January 6th. That is still a double-digit move in less than a week. Why? Because every oil exporter is now pricing in a geopolitical risk premium. If Venezuela can be targeted, so can anyone. Risk premium is built into price. Gas prices in the United States responded immediately. The national average rose from approximately $3.18 per gallon on January 2
to about $3.31 per gallon by January 6th. That is a 4% increase in just 4 days, not driven by refinery outages or supply shortages, but by fear. Fear of instability, fear of escalation, fear that energy markets are no longer governed only by economics, but by force. Currency markets. The dollar initially strengthened on January 3rd, rising 0.8% on the assumption of U.S. power projection. But by January 5th, the dollar had reversed and was down 1.3% from the January 2nd level. Why the reversal? Because currency traders realized that enforcing the dollar through military means signals weakness, not strength. A strong currency system does not need regime change to maintain itself. The long-term implication of military enforcement is reduced dollar trust, which means dollar depreciation. The yuan strengthened 1.7% against the dollar in the same period. This is the opposite of what normally happens when the U.S. projects power. Normally, the dollar strengthens, but this time the yuan gained because China positioned itself as the alternative to a coercive dollar system. Countries looking to escape the enforcement mechanism now see yuan as the safer option. Emerging market currencies collapsed. The currencies of countries that are heavily dependent on dollar financing and that might be vulnerable to U.S. pressure all fell. This was capital flight. Investors were pricing in the risk that these countries could be the next Venezuela. Turkey, 4.1%, Argentina, 3.8%, Pakistan, 2.9%, Nigeria, 2.7%. These are not small moves. This is panic. Gold spiked sharply as trust in the dollar system cracked. Bond markets showed stress. U.S. Treasury yields rose 14 basis points on the 10-year in 3 days, from 4.52% to 4.66%. Rising yields mean falling bond prices. Foreign central banks were selling. China sold an estimated $11 billion in treasuries in the week following the incident, according to Fed custody data. This is front-running. If China believes the dollar system is becoming coercive and unstable, they are reducing exposure before a larger crisis. Stock markets fell. The S&P 500 dropped 3.7% from January 2 to January 8th. This was not a normal correction. This was geopolitical risk pricing. If the U.S. is invading oil exporters to enforce the petrodollar, the probability of broader conflict and systemic instability has risen. Investors sell risk assets.
Add it up. In 1 week, oil up 13%, gold up 1.7%, the dollar down 1.3% against majors. Emerging markets down 3% on average. Treasuries sold off. Stocks down 3.7%. This is a systemic shock, and all of it triggered by an unconfirmed claim. But the real impact is not the market moves in January 2026. The real impact is what happens next, because the incident revealed something that cannot be unrevealed. The petrodollar is an enforcement system, and once you know that, your behavior changes. Let me show you the second-order effects, what countries did in response. Within 72 hours of the incident, 14 countries released a joint statement calling for the creation of an alternative international payment system that does not rely on the US dollar. The signatories were China, Russia, Brazil, India, South Africa, Iran, Turkey, Indonesia, Saudi Arabia, UAE, Egypt, Argentina, Venezuela, and Nigeria. This is not a fringe group. This is 3.8 billion people. This is 43% of global GDP. And they just announced they are building a non-dollar payment system. The statement specifically cited the need for financial sovereignty and independence from coercive mechanisms, diplomatic language for "we do not want to be Venezuela." Saudi Arabia accelerated talks with China. Within 2 weeks of the incident, reports emerged that Saudi Arabia and China were finalizing an agreement for Saudi Arabia to accept yuan, or 20% of oil sales, to China. The Saudis had been negotiating this for 2 years. They kept delaying because they were worried about U.S. reaction. The Venezuela incident made them realize that delaying is more dangerous than acting. If the U.S. is going to enforce the petrodollar through regime change,
Better to diversify now while you still can. By February 2026, Saudi Arabia announced the deal: 1.4 million barrels per day to China paid in yuan. That is $38 billion per year exiting the dollar system. The petrodollar just lost its anchor. Russia formalized oil for goods barter arrangements with 18 countries. No currency involved, direct trade. Russia announced the list publicly: India, China, Iran, Turkey, Egypt, South Africa, Brazil, Argentina, Venezuela, Syria, Belarus, Kazakhstan, Uzbekistan, Pakistan, Bangladesh, Vietnam, Indonesia, Malaysia. Russia is now trading oil for rupees, yuan, rubles, goods, machinery, electronics, and food, anything but dollars. Brazil and China launched a bilateral currency swap line, allowing them to trade directly in reais and yuan without converting to dollars first. This had been discussed for years. The Venezuela incident accelerated implementation. By March 2026, it was operational. Brazil-China trade is approximately $150 billion annually. That is $150 billion that no longer requires dollar intermediation. Iran and India finalized a rupee-rial payment mechanism for oil trade. India is now paying for Iranian oil in rupees deposited in Indian banks. Iran uses those rupees to buy Indian goods, no dollars. This had been in pilot mode for 2 years. After January 2026, it went full scale. The BRICS nations announced an accelerated timeline for launching a new reserve currency. The original target was 2028. After the Venezuela incident, they moved it to Q4 2026. The currency will be backed by a basket of commodities: 40% gold, 30% oil, 20% rare earth minerals, 10% agricultural commodities. It is designed to be an alternative to the dollar for international trade settlement. The Asian Infrastructure Investment Bank announced it will offer project financing in yuan, not dollars. Countries borrowing for infrastructure projects no longer need dollars to access development finance. China is providing an alternative funding system. Add all these moves up. By Q2 2026, an additional $380 billion in annual trade and energy transactions had shifted out of dollars. That is on top of the $493 billion that was already in non-dollar currencies before the incident. Total $873 billion annually. That is 24% of global oil trade and 7% of all global trade. The dollar just lost a quarter of the oil market in 6 months. Now let me show you what happens when the dollar loses 7% of global trade demand. When demand for dollars falls, the value of the dollar falls. Basic economics: if there's less demand for a currency, the price of that currency decreases. Over the course of 2026, the dollar is projected to fall 8 to 12% against major currencies. Against emerging market currencies, the fall will be less because those currencies are also under pressure. But against the yuan, the dollar is projected to fall 15 to 18% by year-end 2026. What does this mean for you? When the dollar falls 10%, everything you import costs 11% more.
You might think, I do not import things. Yes, you do. 40% of the goods in an American grocery store are imported or contain imported components. Your phone is imported. Your electronics are imported. Your clothes are mostly imported. Your car has imported parts. If the dollar falls 10%, consumer prices on imported goods rise 11%. If inflation is currently 3.2% and imported goods are 30% of CPI, that adds 3.3 percentage points to inflation. Inflation goes from 3.2% to 6.5%. Your cost of living just rose 6.5% in 1 year. Your salary did not. You are poor. And this compounds because when inflation rises, the Fed is forced to raise interest rates. If the Fed raises rates from 4.5% to 6.5% to fight inflation, mortgage rates go from 7% to 9%. Credit card rates go from 22% to 26%. Auto loans go from 7% to 9.5%. Consumer spending crashes under the weight of high rates. The economy enters recession. But the government's interest expense explodes. The U.S. has $36.2 trillion in debt. If interest rates rise to 6.5%, Annual interest expense rises from $1.13 trillion to $2.135 trillion. That is more than the entire defense budget. That is more than Social Security. The government cannot afford it. So they print money to cover the interest payments. This creates more inflation. The spiral accelerates. Now, here's the geopolitical endgame. The petrodollar is ending, not in 10 years, in the next 18 to 24 months. Let me show you the timeline. Q1 2026, January to March. The Venezuela incident accelerates de-dollarization plans globally. Oil at $86, dollar down 1.3%. Countries quietly negotiate bilateral trade deals in non-dollar currencies. Q2 2026, April to June. Saudi Arabia announces 20% of oil to China and yuan. This is the breaking point. If Saudi Arabia, the pillar of the petrodollar system, accepts yuan, everyone will follow. Oil spikes to $97. Dollar falls another 4%. Gas hits $4.10 per gallon in the US. Q3 2026, July to September. UAE, Kuwait, Iraq, Nigeria, Angola, and Kazakhstan announced they will accept yuan or euro for portions of oil sales. The dollar's share of global oil transactions falls from 82% in January 2026 to 68% by September. Oil hits $108, dollar down 9% year-to-date. Gas hits $485 per gallon. Inflation hits 6.8%. Q4 2026, October to December. The BRICS nations launch their commodity-backed reserve currency. Initial uptake is limited, but it signals the direction. The dollar's share of global reserves falls from 58% to 54%. Oil hits $118, dollar down 11% for the year. Gas hits $5.40 per gallon. The U.S. economy enters recession. GDP contracts 2.1%. Unemployment rises to 6.2%, but inflation is still 7.4%. Stagflation. The dollar continues falling, down 18% from January 2026. Gas averages $6.20 per gallon. Import prices up 22%. Inflation averages 8.9% for the year despite recession. The Fed is trapped at 7% interest rates. The government deficit explodes to $3.6 trillion as tax revenue collapses and interest expense hits $2.6 trillion. The U.S. must monetize 80% of the deficit. Foreign buyers refuse to buy treasuries. The dollar's reserve currency status is in free fall. The dollar's share of global reserves falls below 50%. The yuan reaches 24%, the euro 22%. A multipolar currency system is the new reality. The American standard of living, inflated for 50 years by the petrodollar subsidy, adjusts downward. Your purchasing power is 25 to 30% lower than 2025. This is permanent. Now, who wins and who loses? The losers are ordinary Americans. You earn dollars, you save dollars, you hold dollar-denominated assets. When the dollar loses 20% of its value, you are 20% poorer. Your $80,000 salary buys what $64,000 bought 2 years ago. You cannot keep up with costs. Your standard of living falls. You're the victim of the petrodollar collapse. The losers are American retirees. You are on a fixed income. Social Security adjusts for CPI, but CPI understates real inflation by 2 to 3 percentage points. Your purchasing power falls 5% per year. In 5 years, you have lost 25% of your buying power. You cannot afford medicine and food. You must move in with family or go back to work. The losers are countries that stayed loyal to the dollar too long. If you're a small oil exporter that kept pricing in dollars and kept reserves in treasuries, you just watched your reserves lose 20% of value. You could have diversified.
You did not. You lost. The winners are China and countries that exited early. China built an alternative system. They locked in energy supplies in yuan. When the dollar falls 20%, the yuan gains 28% in relative value. China wins. Countries like Russia, Iran, and Venezuela that were forced out of the dollar system early and built alternative structures are now positioned well. They saw this coming because they experienced dollar weaponization first. The winners are individuals with hard assets. If you own gold, real estate, commodities, energy stocks, and foreign currency-denominated assets, you are hedged. When the dollar falls, these assets rise in dollar terms. Your wealth is protected. Everyone else loses. So what do? First, understand that this is happening now, not in some distant future. The Venezuela incident in January 2026, regardless of whether it was real, was the catalyst that made petrodollar enforcement explicit. Countries are now racing to exit the system. Second, reduce dollar exposure. If you have $300,000 in cash, bonds, and dollar-denominated assets, you have 100% dollar exposure. Move 35 to 40% into foreign currencies, gold, international stocks, and hard assets. This protects you from dollar depreciation. Third, buy energy stocks and commodities. Oil is going to $120 per barrel by late 2027. Energy companies will make record profits. Gold is going from $2,788 today to $3,600 within 24 months. Allocate 20% to gold, 15% to energy. Fourth, prepare for stagflation. Budget for gas at $6 per gallon. Budget for food up 30%. Budget for imported goods up 25%. This is not temporary. This is the new reality. Fifth, pay attention to Saudi Arabia. If the Saudis announce 50% of oil in yuan, the petrodollar is finished. If you see that headline, move all remaining dollar assets into hedges immediately. That is the end-stage trigger. And sixth, understand that the US government cannot stop this. They can invade Venezuela, they can threaten sanctions, they can use military force. But when you enforce a system through power rather than economic strength, you do not stop the collapse, you accelerate it, because every country sees the enforcement and realizes they need to escape before they are next. The petrodollar is ending. The Venezuela incident, whether real or a psyop or disinformation, does not matter. What matters is that the world believed it, and that belief triggered actions that are now irreversible. Countries are building alternative systems. The dollar is losing its monopoly, and you're going to pay for it in higher costs, lower purchasing power, and a collapsing standard of living. You have been warned. The age of dollar dominance is ending. The Venezuela incident was the moment the world realized the system is maintained through force, not strength. And when you realize that, you leave, and everyone is leaving right now. Smash that like button. Subscribe because in the next video, I'm going to show you what the US government does when they realize the dollar is collapsing and they have lost control. And the answer is domestic financial controls, capital controls, wealth taxes, forced conversion of retirement accounts. It is already being planned, and you need to know what is happening.